Continuing on from last week's session about vanilla strategies as a way to hedge FX exposures, today we'll be talking about faders and average options, a combination of options which allow our corporate treasurer to hedge his $10 million US 1 year cash flow. Faders and average options both provide an effective solution to lower the cost of the premium while increasing the risk profile that our corporate treasurer wishes to maintain in order to hedge its exposures. We will start looking at faders. A fader is just a regular vanilla option where the notional of the vanilla is determined on the expiry date rather than by a predefined value. At expiration, the exact notional depends on a combination of conditions. First of all, the predefined spot condition, which can be set as a range where the spot must be inside or outside the range, or just as a one-sided condition where the spot is above or below a predefined trigger. Why would the treasurer want to buy a fader? The fader comes into the picture because of two relevant factors. The treasurer has a specific view on the spot rate movement and is willing to reduce the premium that he would have to pay on a similar vanilla option. The reduced premium comes into the picture because there is always the possibility that the spot will not move the way he thought, leaving him with an unhedged foreign exchange risk. Another effective way to hedge future FX cash flows is through average options. With an average option, the payout is actually determined by the average value of the underlying asset on a specific set of dates over the life of the option itself, rather than by the value of the underlying asset at expiration. The treasurer can create a combination of average options, average rate options or average strike options or double average rate options. We'll be looking at today at average rate options where the average of the underlying fixings is specified over a month time throughout the life cycle of the option itself. Why will the treasurer buy an average option? Because the payout is actually linked to an average value of the underlying asset on a specific set of dates over the life of the option, and this in turn will create a direct effect on the volatility of the option itself, which in turn will decrease the cost of the volatility itself. As a result, the premium, the average options, tend to be lower than the premiums that the treasurer will pay on vanilla options. When dealing with options and exotic derivatives, it's a best practice to stress test the portfolio in order to assess what will have been the relative impact on the P&L of its position by changing the underlying rates, which are definitely spot rates even for options, but also the implied volatility. By changing those two components, our treasurer will clearly have a good picture, a good representation, and react on that, going onto the market and rebalance his portfolio by restructuring his position. Option Greeks also come in very handy because they provide a good way to understand how the market is moving. And based on that information, the treasurer will have a clear representation of how his P&L is fundamentally changing. Faders and average options are very much popular and in-demand products that corporations are using today to hedge their FX future cash flows. More complex products, such as target redemption forwards or basket on the FX side, also are something that some corporations are looking to use in the near futures. They require something new. They require the corporation to have like a clear view of how the FX market is moving, and also taking on some additional risk, thus altering or enhancing the risk profile that the corporate treasurer wishes to maintain. Risk management practices such as backtesting or stress testing or coming from the IFRS 9 requirements, the hedge effectiveness test at inception and throughout the life cycle of the structures remain must-dos. Corporations need to understand where their internal embedded risk is, and they need to be proactive by looking at that risk and go onto the market and wishing to structure and restructure their own position to protect themselves from unfavorable rate movement.